Well, I've been doing this for a long time now. I started getting interested in investing in business when I was just a teenager back in the late 1960 seconds. That was over 55 years ago. Can you believe that? I was tinkering with computers at Lakeside School in Seattle, writing my first software programs. And by age 19, I co-founded Microsoft in 1975. From there, my journey into serious investing really took off as the company grew. And in those more than 5 decades, I've seen just about everything. I've seen crashes, booms, bubbles, manias. I've seen fortunes made and fortunes lost. I've seen people do incredibly smart things with their money. And I've seen them do incredibly stupid things. And right now, as I'm sitting here in 2026, I'm seeing some things that worry me, really worry me. Things that remind me of other times, times that didn't end well for a lot of people. So today, I want to give you a warning, not to scare you, not to make you panic or do anything rash, but just to make you think, to make you look carefully at what you're doing with your money. Because, see, the market's been good for a long time now. People have made a lot of money. And when that happens, when people make easy money for too long, they start to forget. They forget that markets go down too. They forget that nothing goes up forever. And that forgetting, that's when the real danger starts. So let me share some things I'm seeing, some warnings I want to give you, things I hope you'll take seriously. What I'm seeing right now, well, the first thing I want to talk about is valuations, stock valuations. And they're high, really high, higher than they've been in a long time now. I know people have been saying that for years. Stocks are overvalued, stocks are too expensive, and yet they keep going up. So people stop listening. They think, well, Bill's just an old man who doesn't understand the new economy. But here's the thing. I've been around long enough to know that sometimes stocks can stay overvalued for a long time, longer than seems possible. But eventually reality catches up, and when it does, it's not pretty. See, I look at something called the market cap to GDP ratio. It's basically the total value of all stocks compared to the size of the economy. And right now that ratio is higher than it's ever been. Higher than it was in 2000 before the dot-com crash, higher than it was in 2007 before the financial crisis. Now, does that mean the market's about to crash tomorrow? No, of course not. I can't predict that. Nobody can. But it does mean the margin of safety is thin, really thin. When stocks are cheap, you can make mistakes and still do okay. But when they're expensive, every mistake gets magnified. Every little thing that goes wrong, it hurts a lot more. And that's where we are right now, in a place where there's not much room for error. Think about it this way. Back in the early days of Microsoft, we saw the tech sector inflate wildly in the late 1990 seconds. Companies were valued at astronomical levels based on potential, not profits. And when the bubble burst, it wiped out trillions. We're seeing similar patterns today, especially in emerging tech areas. The speculation I'm seeing. Now, let me talk about something else that's worrying me, and that's speculation, pure speculation. See, when I started out, people bought stocks because they wanted to own a piece of a business. They looked at earnings, they looked at dividends, cash flow, competitive advantages. They were buying businesses, not lottery tickets. But now, a lot of what I see, it's not investing, it's gambling. People buying stocks or crypto or meme stocks or whatever the latest thing is just because they think the price will go up. Not because they understand the business, not because they think it's worth what they're paying, just because they think someone else will pay more tomorrow. That's not investing. That's speculation. And speculation, well, it doesn't end well. I saw this in the dot-com bubble. People were paying ridiculous prices for companies that had never made a penny of profit. Companies that were just ideas, really, not businesses. And everyone said, this time it's different. The old rules don't apply. you just don't understand the internet, Bill. Well, I didn't understand a lot of those businesses. That's true. But I understood enough to know that you can't value a business based on dreams. You have to value it based on reality. And the reality was most of those companies were worthless. And when reality finally showed up, people lost everything. Trillions of dollars just vanished. Now, is that what's happening today? I don't know. Not exactly. But there are echoes. There are similarities. People buying things they don't understand, paying prices that don't make sense, ignoring fundamentals, believing that somehow this time the old rules don't matter. And that's always a warning sign. Just look at the AI boom. Right now, it's mirroring that dot-com era. Tons of investments are pouring in, but many will turn out to be dead ends, just like back then. It's not tulip mania, but it's a bubble where hype outpaces reality, and when it bursts, it'll hurt those who chase the hype without understanding the tech. I've been saying this for a while now, that we're in the midst of an AI bubble, similar to the dot-com bubble. There are a ton of investments that will be dead ends. Companies building massive data centers that might end up costing more in electricity than they're worth, or chips that become obsolete overnight. But here's the key difference from something like Tulip Mania in the 1600s. AI actually has profound value. It's the biggest technical thing I've seen in my lifetime. It could transform medicine, giving everyone a personal doctor, education with tutors for every student, even drug discovery, speeding up cures for diseases that plague humanity. So yes, there's frenzy, billions flowing into startups and infrastructure, but unlike pure speculation, this tech will change the world. Still, for investors, the warning is clear. Most of these bets won't pay off. A recent study showed that 95% of companies experimenting with AI are seeing zero return on their investments. Why? Because the tools boost individual productivity, sure, but they fail to integrate into broader workflows. They don't learn context well, and they're not solving real business problems at scale. If you're pouring money into AI stocks just because they're hot, without understanding the underlying technology or the company's path to profitability, you're gambling, not investing. And in 2026, as the shakeout begins, a lot of those overvalued firms will crash, just like the dot-coms did. But the survivors, they'll be the ones creating real economic transformation. So be cautious, focus on AI companies with solid fundamentals, not just hype. Take Microsoft, for example. We've integrated AI into our products like Copilot, and it's showing real results in productivity gains for users. But even there, we're careful not to overextend. The cash I'm holding, well, let me tell you something that might surprise you. The Bill and Melinda Gates Foundation Trust, the investment vehicle I've been overseeing for over 25 years now, we're sitting on a significant cash position after some recent trims in our holdings. Our total portfolio is around $49 billion, but we've been selling off portions of key stocks like Microsoft, where we reduced our stake by 65% in the third quarter of 2025, unloading nearly 17 million shares worth around $8.7 billion. We also trimmed other holdings like Waste Management and Canadian National Railway. Now, why would we do that? Why would we hold more cash when stocks have been going up? Because we can't find anything worth buying, not at these prices. See, I've always said you should be greedy when others are fearful and fearful when others are greedy. And right now, people are greedy, really greedy. They're paying prices for businesses that just don't make sense, prices that assume everything will go perfectly, that growth will continue forever, that nothing will ever go wrong. And in my experience, things always go wrong eventually. So, we're holding cash, waiting, being patient, and I'd encourage you to think about doing the same thing. Not holding all your money in cash, but having some dry powder, some money on the sidelines. Because when the market does correct, and it will eventually, you want to have cash available to buy. to take advantage of the fear, to pick up great businesses at reasonable prices. That's how you make real money in the market, not by chasing what's already gone up, but by buying what's been beaten down. Look at our top holdings now. Microsoft still at about 28.6%. Waste Management, Canadian National Railway. These are quality companies with strong moats. But even there, we've been trimming to prepare for opportunities. In a world where AI and tech dominate headlines, we're sticking to diversified, reliable businesses, but with cash ready for when valuations make sense again. This strategy has served the foundation well, allowing us to fund global health and education initiatives without being forced to sell at bad times. The interest rate environment. Now, let me talk about interest rates for a minute, because interest rates are incredibly important. They're like gravity for the financial system. When interest rates are low, it makes stocks more attractive. It makes everything go up. Real estate, bonds, private equity, everything. But when rates go up, it's like turning up the gravity, everything gets pulled back down. And over the last few years, we've been living in a world of very low interest rates, near zero. And that's made people comfortable, made them willing to take risks, made them willing to pay high prices for things. But rates have been going up, and they're going to stay higher than they were, maybe not super high by historical standards, but higher than what people have gotten used to, and that changes everything. See, when you can get 5% on a treasury bill with no risk, why would you take a huge risk on some speculative stock? Why would you pay 30, 40, 50 times earnings for a company? It doesn't make sense. The math doesn't work anymore. So as rates stay elevated, I think you're going to see a shift away from speculation, away from growth at any price, and back toward fundamentals, toward businesses that actually make money. And that shift, it's not going to be comfortable for people who've been riding the speculation wave. Higher rates will expose the weak spots in the economy, like over-leveraged companies or sectors bloated by cheap money. Think about real estate commercial properties are already feeling the pinch with vacancies up and refinancing costs soaring, or tech startups that burn through cash assuming endless low-rate funding. In 2026, as rates hold steady or even tick up if inflation lingers, we'll see more defaults, more corrections. But it's also an opportunity to invest in resilient sectors like infrastructure or utilities that can pass on costs. Back in 2015, I warned that prolonged low rates could lead to excessive leverage and bubble risks, and we're seeing some of that play out now as rates normalize. It's a reminder that easy money distorts decisions, pushing people into riskier bets they might regret. What most people get wrong? Well, I've noticed something over the years. Most people think investing is about picking the right stock, finding the next Apple or Amazon or whatever. And if you can do that, great, but that's really hard even for professionals. What most people don't understand is investing is mostly about avoiding mistakes, about not doing stupid things. See, if you can just avoid the big mistakes, you'll do fine. You'll probably do better than most people. But people can't help themselves. They see something going up and they chase it. They hear about some hot stock and they buy it without understanding it. They panic when things go down and they sell at exactly the wrong time. They do all the things you're not supposed to do, and then they wonder why they're not making money, why they're not getting rich. Well, it's because they're making all the classic mistakes, the same mistakes people have been making for hundreds of years. So here's my advice. Don't try to be a hero. Don't try to find the next big thing. Just be smart, be patient, be disciplined, buy good businesses at reasonable prices, hold them for a long time. Don't panic when things go down. That's it. That's the whole secret. But people think it's boring. They think there's got to be more to it than that, but there's not. It really is that simple. It's just not easy because it requires patience, discipline, emotional control, and most people don't have that. Take for example, the rush into green energy stocks a few years back, everyone thought it was the next sure thing, but many ignored the fundamentals like supply chain issues or policy risks and got burned when subsidies shifted. Avoiding those hype cycles is key. Or look at how we manage the Gates Foundation portfolio. We focus on stable, dividend-paying companies like Waste Management, which handles essential services no matter the economy, or railroads like Canadian National, which have durable competitive advantages in logistics. These aren't flashy, but they've delivered steady returns over decades, helping fund our work in eradicating diseases like polio and malaria. The role of emotions. Now, let me talk about emotions for a minute, because emotions are the enemy of good investing. They really are. When the market's going up, you feel great, you feel like a genius, and that makes you want to buy more, makes you want to take more risks. And when the market's going down, you feel terrible, you feel scared, and that makes you want to sell to get out, to protect what you have left. But those feelings, those natural human feelings, they lead you to do exactly the wrong thing. You buy when you should sell, you sell when you should buy, you do the opposite of what you should do. And see, this is why most people underperform the market, not because they're stupid, but because they're human. They can't control their emotions. They can't resist the pull of fear and greed. So my advice to you is this: before you make any investment decision, ask yourself, am I making this decision based on logic, or am I making it based on emotion? If it's emotion, if you're buying because you're excited or you're afraid of missing out, or if you're selling because you're scared, stop. Just stop. Take a breath. Wait a day. Wait a week. Let the emotion pass. And then when you're calm, when you're thinking clearly, then make your decision. Because decisions made in the heat of emotion, they're almost always wrong. I've seen this play out in my own life from the early days of Microsoft, when hype around tech stocks swung wildly, to more recent bubbles. Emotions drove people to buy at peaks and sell at troughs, wiping out gains. Even in philanthropy, I've learned to approach big decisions like committing billions to vaccine development with data and logic, not just passion, to maximize impact. The danger of debt, well, here's something else I want to warn you about. Debt, borrowing money to invest. Now, I know when the market's going up, using leverage seems like a great idea. You borrow money at, say, 5%. You invest in stocks that go up 15% and you make a killing. And people do this, they do it all the time. Margin accounts, options, leveraged ETFs, all kinds of ways to amplify your bets. But here's the thing about leverage. It amplifies everything, the gains and the losses. And when things go wrong, when the market drops, leverage can wipe you out completely. I've seen it happen so many times. Smart people, experienced people, people who thought they knew what they were doing, and they leveraged up, they borrowed, they used margin, and then the market dropped 20%, 30%, 40%, and they got margin calls. They had to sell at exactly the wrong time, and they lost everything. Not just their gains, everything. Their life savings gone. That's heartbreaking, and it's avoidable. Don't use leverage. Don't borrow money to invest. Just don't. I've never used significant leverage in my entire life. Never needed to, and I've done just fine. You don't need leverage to get rich. You just need time, patience, and good businesses. So please don't gamble with borrowed money, because when you do, you're not just risking your gains, you're risking your entire financial future. In today's environment, with rates higher, debt is even more dangerous, borrowing costs more, and if asset prices fall, the pain is amplified. Think about the real estate investors who loaded up on cheap debt pre-rate hikes. Many are underwater now. Instead, focus on building wealth steadily, like through our strategic investment fund at the foundation, which uses flexible tools like guarantees but avoids reckless leverage to support markets in developing countries. What I do if I were starting today, now people ask me sometimes, Bill, if you were starting over today, what would you do? And it's a good question, a hard question, because the world is different now than when I started. There's more information, more complexity, more noise, but the fundamentals are the same. The principles haven't changed. So here's what I'd do. I'd start by reading everything I could, annual reports, books on investing, financial statements. I'd educate myself, really educate myself, not just watch YouTube videos or read Twitter threads, but dive deep, understand how businesses work. Then I'd find a simple low-cost index fund, an S&P 500 fund, and I'd invest regularly every month, every paycheck, automatically, and I'd hold it through ups and downs, through crashes and booms. I'd just hold it. That alone would put me ahead of 90% of people, maybe more. And if I wanted to do more, if I wanted to pick individual stocks, I'd only buy businesses I understood, businesses with strong competitive advantages. Businesses I'd be happy to hold for 10, 20, 30 years. I wouldn't try to time the market, wouldn't try to trade in and out, wouldn't chase the hot stocks. Just buy good businesses, hold them, let compounding do its work. That's it. That's what I do. And you know what? That's still what I do today. You know, at 71 years old, that's still my approach because it works. It's always worked. And I don't see any reason to think it'll stop working. If I were young today, I'd also look at sectors like AI and clean energy, but only after understanding them deeply, not jumping in blind. I'd invest in myself first, building skills that never go out of style, like coding or problem solving, which is what I did as a kid, programming on a GE time-sharing terminal. And I'd be frugal, avoiding unnecessary expenses to build a savings buffer. Setbacks would be my teachers, just like the antitrust battles at Microsoft taught me resilience, the coming opportunities. Now, I don't want you to think I'm all doom and gloom here, because I'm not. I'm optimistic. Always have been. America's an amazing country. The businesses here are incredible. The innovation, the productivity, the ability to adapt and overcome, it's unmatched. And over the long term, the stock market will go up. It always has, it always will. But in the short term, there are going to be opportunities, big opportunities. When the market corrects, and it will eventually, when people panic and sell, that's when you want to be ready. That's when great businesses go on sale, when you can buy wonderful companies at reasonable prices or even cheap prices. And those are the moments that create wealth, real lasting wealth. So while everyone else is scared, while they're selling and panicking and running for the exits, you want to be calm, thinking clearly, looking for opportunities. That's how I've approached investing, not by being the smartest guy in the room, but by being patient, by waiting for the fat pitches, and then when everyone else was scared, swinging hard. And you can do that too. You just need to be prepared, have some cash, have some courage, and have the discipline to act when others won't. Look ahead to 2026, geopolitical tensions, supply chain issues, or an AI shakeout could trigger corrections, but that's when bargains emerge in solid companies like those in infrastructure, healthcare, tech. For instance, through Breakthrough Energy, I've invested billions in clean tech startups, not for quick flips, but because they address climate challenges that will yield long-term returns for humanity. The importance of a long-term view. Well, one more thing I want to emphasize, the importance of a long-term view, of thinking beyond next week, next month, next year. See, most people are focused on the short term. They check their portfolio every day. They worry about every little fluctuation. Every time the market drops 2%, they panic. And that's exhausting and counterproductive, because investing is not about what happens today or tomorrow. It's about what happens over years, decades, over a lifetime. when you buy a stock, you shouldn't be thinking, what's this going to be worth next month? You should be thinking, what's this business going to look like in 10 years, in 20 years? And if you can't answer that question, if you can't envision what the business will be doing a decade from now, then you probably shouldn't buy it, because you're not investing, you're just speculating. But if you can identify businesses that will still be thriving in 10, 20, 30 years, businesses with durable competitive advantages, then you can hold them with confidence. You can ignore the short-term noise, the daily ups and downs, the headlines, and the panic, because you know that over the long term you're going to do well. That's the power of a long-term view. It gives you clarity, confidence, peace of mind, and it lets you do what most people can't do, which is hold on through the tough times, through the crashes and the bear markets and the fear, because you're not focused on today, you're focused on the long term, and that makes all the difference. Extending this to global challenges like climate change, I've been investing billions in breakthrough energy ventures, not for quick returns, but because in 20 years, low carbon tech will be essential. We're pivoting our strategy to focus more on human welfare, adapting to climate impacts rather than just emissions cuts, because temperatures will rise no matter what, and we need to save lives in vulnerable areas. That long-term lens applies to investments too. Bet on companies solving real problems like affordable green cement or resilient agriculture. Similarly, in global health, the Foundation's investments in vaccines have paid off over decades, reducing child mortality dramatically, though I warn that 2025 could see rising child deaths if funding dries up. My warning for 2026, let me bring this all together now. My warning for 2026 is this: be careful, be prudent, be aware. We're in a tricky environment right now. Stocks are expensive. Speculation is rampant. People are making risky bets with borrowed money, and that's a recipe for trouble. Now, I don't know when trouble will arrive. Could be next month, could be next year, could be years from now. But it's coming. It always does. And when it does, you want to be ready. You want to be positioned to survive it. And if you can, to take advantage of it. So here's what I'd encourage you to do. First, take a hard look at your portfolio. Really look at it. Are you taking too much risk? Are you speculating? Are you holding things you don't understand? If the answer is yes, make changes now before the market makes them for you. Second, have some cash on hand. Not all your money, but some. Enough that if the market drops 20%, 30%, 40%, you can buy, you can take advantage. Third, avoid debt. Don't leverage, don't borrow to invest. It's not worth the risk. Fourth, focus on quality, on businesses with strong competitive advantages, businesses that can weather storms, businesses you'd be happy to hold for decades. And finally, keep a long-term view. Don't panic when things get rough. Don't sell just because the market's down. Because if you own good businesses, they'll recover, they'll come back, and you'll be fine. But if you panic, if you sell at the bottom, you'll lock in your losses and you'll miss the recovery. And that's the real tragedy. Adding to that, watch the AI sector closely. It's transformative, but expect dead ends. Invest in leaders with proven models. On the global front, economic pressures from declining aid and rising child mortality in poor countries could ripple into markets. So diversify internationally, but wisely. Remember, I've committed to giving away virtually all my wealth through the foundation over the next 20 years, doubling our giving to over $200 billion for causes like health and education. That's the ultimate long-term investment in a better world. A final thought. I've been through a lot of market cycles in my life. The crash of 73 to 74, Black Monday in 87, the dot-com bubble, the financial crisis in 2008. And every single time, people said, this is it, this is the end. The market will never recover. And every time they were wrong, the market always recovered, America always bounced back, and the people who stayed calm, who stayed invested, who kept buying good businesses, they did just fine. Better than fine, actually. So yes, I'm worried about some things I'm seeing right now. Yes, I think we're in for some turbulence, some pain maybe, but I'm not worried about the long term, not at all. Because America is still the best place in the world to invest. Our businesses are still world class. Our innovation is still unmatched. And as long as that's true, the stock market will go up over time. So my warning is not get out of the market. It's not sell everything and hide under a rock. It's just be smart, be careful, be prepared. Don't get caught up in the speculation. Don't make emotional decisions. Don't take unnecessary risks. And when the market does correct, when the fear sets in, remember that it's temporary, that it always passes, and that the best opportunities often come when everyone else is scared. That's my warning. That's my advice. That's what I wanted to share with you today. I hope you'll take it seriously. I hope you'll think about it, because I've been doing this for over 55 years. And if there's one thing I've learned, it's that the market will humble you if you're not careful. But if you are careful, if you're patient and disciplined and focused on the long term, it can change your life. Take care of yourself, take care of your money. And remember, the best investment you can make is in yourself, in your education, in your discipline, in your character. Do that and the rest will take care of itself. So if you're watching this video, act now, review your investments, save like a pessimist, but invest like an optimist, and prepare to seize those opportunities. Thank you for listening.